See, in this episode, we shall discuss how we can carry out the valuation of rights. But before everything else, let's start with the most basic thing. What do we mean by a right? It is also so many a times referred as right shares. It is also known as a rights issue. But what exactly do we really mean by the same? Whether you say simply right or right shares, rights issue, what is it all about? Now, the Companies Act in India suggests that, see, if any existing company is in need of additional funds, it should first approach its existing shareholders. For example, let us say I am a publicly listed company. I am in need of additional funds. So before I invite the general public at large, I will first invite my existing shareholders. I will inform my existing shareholders that, see, this is the amount of money that is required. Let's say the money is needed for expansion of the business. So we will communicate to our existing shareholders that, see, this is the total fund which is required to be raised, and this is the purpose for which it is to be raised. And we will also declare what is known as a rights ratio. Let us say the rights ratio is 1:5, let's say. That means for every 5 shares held by our existing shareholders, they can apply to one additional share. Now, since I'm approaching my existing shareholders may or may not apply for the issue. This is the reason it is popularly known as rights. As an existing shareholder, you have a right to subscribe to the additional shares, but no obligation to do so. You get my point? So let us say if I'm an existing company, I'm in need of additional funds, you are an existing shareholder, I will communicate to you that, see, for every 5 shares that you are owning in my company, I am ready to offer one additional share. Okay, now you will decide as an existing shareholder whether you want to apply for my shares or not. That is the reason it is popularly known as a rights issue or a right share, because you as an existing shareholder has a right. If you wish, you will apply for the share, or you may renounce your right. Renouncing the right means you will not apply for the shares. Not only that, you can even transfer your right in favor of someone else. For example, you are not interested in subscribing for the right shares, but your friend is interested in, your neighbor is interested in. You can renounce the right in favor of your friend, or I will say in favor of a third party, and on your behalf, that third party can apply for the rights. Fine. So this is basic, we can say the basic concept of what we mean by a right. Now, one extremely interesting thing. Although we are although we are urging our existing shareholders that why don't you apply for additional shares, but you know what? The company itself does not know who are its shareholders. This is something that definitely happens in a publicly listed company. Every day shares are being purchased and sold. Every day the ownership of the shares is changing. For example, I may have purchased shares of some company. After 2 days, I sell away the shares. Then whoever has purchased the shares from me, after a few days, even that person is also selling away the shares. Shares is constantly changing hands. The company wants to the company wants to urge its existing shareholders, communicate to its existing shareholders that please apply for the rights issue, but the company does not know who are its existing shareholders. So you know what a company will do? The company will declare what is known as, for the rights issue, the company will declare what is known as a record date. Okay, let us assume for a moment that the record date is 12th November. Okay, so what does that mean? Whoever, right? What will happen on the record date? Whoever's name appears as a shareholder on 12th November, they will be eligible for the rights issue. As I said, I've already issued the shares in the past. Every day, the ownership of the shares is changing because every day, millions of people are buying and selling shares. I want to communicate to my existing shareholders that, see, I am coming up with a rights issue. But as a company, I don't know who is my shareholder right now. So I announce a record date. On the record date, okay, on the record date, 12th November, we shall prepare, we shall prepare shareholders register. Okay, I'll prepare the shareholders register. And whoever's name appears on 12th November as a shareholder, they are eligible for the rights issue. In other words, let us say you are not a shareholder right now. Think in this way. You are not a shareholder right now, but you are interested in applying for the rights issue. Now, rights issue can be applied only by existing shareholders. You are not a shareholder right now. So what you can do is, let's say, for example, on 9th November, okay, on 9th November, you can buy the share and see to it that on the record date, 12th November, your name appears as a shareholder. The moment your name will appear as a shareholder, you will become eligible to apply for the rights issue. You get my point? Similarly, let's say you are not interested in the rights issue. If you are not interested in the rights issue, then buy the share on 13th November. The moment the record date will go, right? The moment the record date is passed, after that, if you are buying shares, then your name will not appear as a shareholder. And if your name does not appear as a shareholder, you are not eligible for the rights issue. You get my point? So the important thing is the record date, 12th November. Whoever's name will appear as a shareholder on 12th November will become eligible for the rights issue. One more thing. Up to 12th November, okay, up to the record date, that is up to 12th November, the share price on the stock exchange will be known as come rights price. Okay, it will be known as come rights price. Come rights price means it is a share price including the right. If you are buying the share on come rights basis, it means you buy the share and you will be eligible for the rights issue. The moment the record date is gone, the share will start trading on X rights basis. So that will be known as an X rights price. X excluding. X rights price means if you buy share on X rights basis, you are now no longer eligible for the rights issue. So if you want to be eligible for the rights issue, if you are really interested in subscribing or applying for the rights shares, it is absolutely necessary that you are buying shares on come rights basis. Okay, now coming to the main point. How can I carry out the valuation of a right? Okay, for that I take some figures. Let's assume for a moment that come rights price is rupees 100. Let us say the X rights price is rupees 88. And let's say the subscription price for the rights issue. See, the share is right now trading for 100 rupees. If you wish that your existing shareholders apply for the rights, then a company should ensure that the subscription price of the rights is less than the current market price. For example, the share is trading right now on the stock market for 100 rupees. You are my existing shareholder. Now, what I do is I communicate to you that why don't you buy my rights shares? And then I tell you that my subscription price, okay, I suggest to you that my subscription price is 120 rupees. Now, share is already trading at 100. If you are really interested in buying additional shares of my company, you can buy directly on the stock market for 100. Why will you pay me 120 rupees? Isn't it? So if I really want to see to it that you are applying for the right shares, I should give my share at a slight discount to the current market price. When I say discount, I don't mean discount to the face value. I mean discount to the current market price. For example, I tell you that the subscription price is 80 rupees. Let us say you are very much satisfied by your investment in my company. Now I am suggesting to you that, see, the share is right now trading at 100 rupees on the stock market. But if you want to apply for the rights, I am offering my own share at 80 rupees. if I am offering my own share at a discount of 20 rupees to the market price, obviously you will be interested in applying for the shares, right? So let's take these three figures, and based on these three figures, let's understand how a right can be valued. So we really want to discuss how the valuation can be carried out, right? We want to understand the valuation of right. Now, there are two ways in which the right can be valued. Try to understand both the ways in which it can be done. Now, one way of valuing the rights is thinking in this way. See, the come rights price over here is 100 rupees. And the X rights price over here is 88 rupees. Right? One is 100 rupees, another is 88. Now, what is come rights price? If you are buying the share on come rights basis, that means you are eligible for rights. And if you are buying share on X rights basis, then you are not eligible to apply for the rights. So, including the right, it is 100. Just a second, this thing just disappeared. Just a second. Yes, X rights price. So what I am suggesting is that if you want the right, you have to pay 100. And if you do not want the right, you have to pay 88. So one way of valuing a right is that why don't we compare the come rights price and the X rights price? And we argue that the value of the right is 100 minus 88, which is turning out to be rupees 12. Isn't it? So this is one way in which the calculation can be done, where the come rights price is been compared with the X rights price. Again, I repeat, in case if you missed out, are you interested in applying for the rights issue? You say yes. Then you'll have to buy share on come rights basis. In that case, you will have to pay 100 rupees. You are saying that no, I am not interested in the rights shares. Fine, then buy the share on X rights basis. For that, you will have to pay 88 rupees. So 100 is including the right, 88 is excluding the right. So 100 minus 88, 12, I can argue is the value of the right. One more way in which we can carry out the valuation of the rights. See, we know that the subscription price is rupees 80. So if you want to buy a right share, you will have to pay 80 rupees, right? So 80 rupees will be paid by us. Now, if you are of the view that I will buy the share for 80, and once the share is coming to my Demat account, then I will sell the share for 100 rupees. Many times we compare this, that the market price right now is 100 and I will buy or I will apply for the rights as 80. So I will pay 80 rupees to the company, and then that right will be sold by me at 100, and I'll make a profit of 20 rupees per share. That will not happen. That will not happen. The reason is you buy the share for rupees 80. By the time the share will come in your Demat account, the share would have started trading on X rights basis. And we know in our example, the X rights price is 88. So something that you are buying for 80 can be sold for 88, and thereby you can make 8 rupees per share. This also can be understood as value of a right. What I do here is I say it is 88 minus 80, and thereby I make 8 rupees over here, right? So this is what I do here. I'm making a gain of 8 rupees. So these are two ways in which a right can be valued. I apply for the share for 80. The share comes to my Demat account. By that time, the record date would have gone. So the share is now trading on X rights basis. So what I purchase for 80, I can sell for 88. I can make a profit of rupees 8. I can say this profit of 8 is because of sale of right. So I can consider that also as the value of the right. Getting it? So these are the two schools of thought for valuation. This is what is known as come rights value, and this is what is known as X rights value. Okay, these are the two ways in which the right can be valued. If you are seeing it as a formula, right, how will you get the come rights value? Come rights value will be calm rights price. Okay, calm rights price minus X rights price. Simple. This is how I'll get the calm rights value. How will you get the X rights value? Here you will take X rights price, and from that you will deduct the subscription price. That is what will give me the X rights value. Comfortable, right? So that's how the two values can be determined. If the question simply says value right, you may apply both of them and work out the value of the right. If the question is specific, calculate cum rights value, X rights value. Accordingly, you can work out the value of the right. So whether you are calculating cum rights value, X rights value, one thing remains common, and that's the X rights price. Okay. See, understand one thing. This cum rights price will be easily available. What is cum rights price? The share price right now. Call up the broker and ask the broker, what is the share price right now? You will directly get the cum rights price. Subscription price is something that the company has already announced. The company will say that, see, our rights issue is 1:5 and our subscription price is 80 rupees per share. What will be really unknown will be the X rights price. Once the record date will be gone, then the share will start trading on X rights basis. So X rights price is something that will be decided later on, isn't it? But if you want to do the valuation as on today, then X rights price also has to be known as on today. But X rights price will be known only in future. So we have a theoretical framework by which we can estimate that what can be the expected X rights price. What I'm saying is, cum rights price will be always available, right? This is the price right now. Subscription price is also available. But the valuation can be done only if I know what will be the price of the share on X rights basis. X rights basis is something that will happen in future. But the valuation has to be done today. I can't wait till the future event has occurred and then carry out the valuation. So valuation has to be done right now. But X rights price will be known in future. So what I'm saying is that there is a theoretical framework available by which we can roughly estimate that what shall be the X rights price. Okay, so let's try to understand that if X rights price is not given, then how can I work out the X rights price? Okay. X rights price, the theoretical framework that we have is that the X rights price will be equal to MN plus cash collected, and then I'll explain you the rationale of the entire formula. MN plus cash collected divided by revised number of shares, right? This is how I'll work out the X rights price. Understand the logic of it. M into N. M is the market price right now. N is the number of shares right now. So you know what this is doing? This is giving you the existing market capitalization. You can even use the word that this is your existing market value. What is the market value of the company right now? Okay, so M is standing for term rights price. N is standing for number of shares right now. Before you come up with the rights issue, how many shares are there? And before you come up with the rights issue, what is your latest market price? So this is giving you what is your existing market capitalization. In other words, it is giving you what is your existing market value. Now, this market value of the company will increase after the rights issue. Why? Because when the shareholders will start applying for the shares, the company will start collecting the cash. There shall be a cash inflow. Cash inflow means the cash and bank balance will increase. Cash and bank balance is an asset. So by that amount of the asset, the value of the company will increase. That is the reason the existing market capitalization, if you see the formula, we are adding the cash collected. You know what this total will do? This total will give you value of company. after rights. If you want to be even more elaborate, you can say this will be the expected value of the company after the rights, isn't it? So existing market value plus expected rise in the market value because of the cash collected. This will give me that after the rights issue, what shall be the total market value? That total market value I'm dividing by number of shares after the rights. That's what I'm calling as the revised number of shares. I hope it's making sense. Existing market value plus expected increase in market value because of the cash collected. So this is giving me expected value of company after the rights issue. And I will divide that by how many shares are there after the rights. That's your revised number of shares. And that is what will give me the X rights price. How will you get cash collected? Very simple. What are the total number of rights that you will issue multiplied by the subscription price? In our example, the subscription price is 80 rupees. So at 80 rupees, how many rights you are going to issue? You may say 1 lakh. Okay, 1 lakh into 80. So 80 lakhs is the cash that is going to get collected. One more thing. One more thing, and really interesting. There is also another possibility. Here we are taking the cash collected. Now, what's one more possibility? One more possibility is that they may give you information with respect to synergy. You remember synergy, mergers and acquisition. We understand synergy as increase in the market value of the company. Okay, till now we were arguing that cash collected will be the increase in the market value of the company. Let us say we are of the view that because of the rights issue, by so and so amount, the profit of the company will increase. Okay, so we are expecting, right? We are expecting additional profit. So we will take the additional profit to equity shareholders and we multiply this by the PE ratio. This will give me synergy. Synergy is, as I said, expected increase in the market value. So if synergy information is given, then in this formula, replace the cash collected by synergy. Consider synergy this time and then work out what will be the value of the company after the rights and divide that by what are the number of shares after the rights. By chance, if you have forgotten that what is synergy, then you can just go to our section of mergers and acquisition. There is one episode which is devoted to synergy. You can watch that episode and you can refresh yourself about the synergy. Otherwise, what we understand by way of synergy is the expected rise in the value of the company. When will you use synergy in this formula? If they have given you any profit details, if they have given us that, see, the cash collected will be invested in this project will generate so and so amount of profit, and it will be generated at so and so PE, right? So and so price earnings time is given. Then take that additional profit, multiply that by the P ratio. That will give you the synergy. Expected rise in the company's value. Add to that the existing market value and divide that by the number of shares expected after the rights. This also will give you the X rights price.